I don't believe that we're in a commodity super cycle yet with regards to industrial materials like oil and copper. I think the best is yet to come there. In the gold sector, we are absolutely positively in a bull market. There's zero doubt about that. People can review prior interviews with you and I about the reasons for that. And I don't think that we are in the late stages of that market. I would suggest that we're in the early to middle stages. The confirmation of that is the recent breakout of silver compared to gold. In my experience, this happens when the momentum established by gold induces the generalist investor into the precious metal space. For whatever reason, and I don't know what the reason is, when the generalist comes into the precious metal space, silver begins to outpace gold. I suspect it's because of the lower unit price of silver, but I don't know that. What I do think is that the fact that silver has outpaced gold 2-to-1 this year suggests that we are at that point in time in the market where the generalist investor is now coming into our space. I repeat, we are not, in my opinion, in a broad-based natural resources bull market. The fact that the copper price is up 5% when you have a structural supply deficit and 7% of the world's copper supply is offline suggests to me that the global economy is weaker than many people believe, and hence the spot copper price is much weaker than it otherwise would have been. One would expect a 7% decline in supply in a structurally deficient market would have generated a 25 or 30% price response as opposed to a 5% price response. Similarly, the fact that the oil price is down in a market where supplies, at least from politically reliable countries, is declining, suggests that near-term demand for oil is very weak. Supplies are weak, demand is weak, prices fall. My belief is that both of these circumstances sort themselves out by structurally lower supply, and that at some point in time in the next 2 or 3 years, on top of a gold bull market, we begin to enjoy an industrial materials or broad-based natural resource market. I remember the confluence of those two markets twice before in my career. One in the decade of the 1970s, a market to remember. The other in the decade between 2000 and 2010, another spectacular market. Life has decided, Lucian, to grant me one more hyper bull market in my career, and I'm grateful. I'm overweight cash. That has occurred for a couple of reasons. I spent 35 years developing a passive developed real estate portfolio, which I sold in 2022 and 2023. Not because of any call in real estate, but simply because I believed that interest rates were going up, and an amateur like me had no place in real estate. It turned out to be a very fortuitous sale, but I haven't been able to reapply all of the proceeds. As you also know, recently, 8 or 9 weeks ago, I sold a quarter of my junior resource stocks. I did that because by selling a quarter of my junior resource stocks, I could recoup all of the capital I had invested in the sector and pay the capital gains tax. I gave up 25% of my upside in return for eliminating my downside. Importantly, I redeployed that capital into senior gold stocks and into the oil and gas business. In more direct answer to your question, I think I'm getting this right. About 40% of my portfolio is liquid. I consider my bullion to be liquidity. So you need to understand, I personally save in gold, and I maintain liquidity in short-term US dollar instruments. Between gold and liquidity, about 40% of my portfolio is liquid, which is way too much. I'm working to reduce that. Of my active portfolio, which is to say of the 60% that remains, approximately a third is invested in conventional financial services. Community banks, insurance companies, wealth managers, asset managers, including the shirt I have on, Battle Bank. My gold equities, depending on how you define gold equities, is about 10% of my portfolio, weighted by now about 50-50 to seniors and juniors, with the preference by now probably going back to the juniors. About half of my natural resources portfolio is in the oil and gas business, and that number will undoubtedly grow. Oil and gas is hated. Oil and gas is a better business than mining. And I have a lot of experience in oil and gas. So I would suggest that the greatest growth in my own portfolio in the next 2 years will be in the oil and gas sector. Every new investment I consider, I write myself a one-page memo as to why I'm buying the stock, what the risk-reward parameters are, what my targets are, and what would cause me to sell the stock. And then in every circumstance, I weigh every new investment against what I consider to be the finest company in that sector. And if the new addition can't hold its own, it is almost every time higher risk. But if the new position can't meet the benchmark, I don't buy it. So as an example, if I were buying a gold company, I would benchmark it both in terms of price, but also in terms of value and outlook against both Franco-Nevada and Agnico Eagle, understanding that the small company has more upside, but life is really about the juxtaposition between upside and downside. Similarly, in the oil and gas space, I would benchmark any new oil and gas company against Exxon. Nothing stands up 1-to-1 against the best company in the group. It's all about the juxtaposition of upside to downside. So as an example, if I saw an exploration prospect generator that had a series of unanswered questions that, if they became true, and if I trusted the management, and if I liked the counterparties, I believed had the possibility of being a 10-fold increase or a 20-fold increase, if my entry price was correct, if my entry price was attractive, I would likely write a check to that company as opposed to increasing my position in Franco-Nevada or Agnico Eagle. But if I felt that the downside risks were too great or the upside potential was too muted, I would prefer to add to my positions in the best of the best, where I don't feel it is incumbent on me to do as much work as I would have to adding a junior to my portfolio. I think every investor would be benefited by making themselves write a one-page memo to themselves about why they are investing in something and what would cause them to sell it. What would success look like? What would failure look like? And how would they determine on at least a quarterly basis whether the more probable outcome was success or failure? It's made me a remarkably better investor. I began doing this in the middle part of the decade of the 1980s. And I would say that as much as anything else has contributed to my investment success over the last 40 years. I'm trying. Lyn, you're familiar with the Rural Classroom, where we have 15,000 members now learning about resources, and important, and not just learning from me, but rather teaching each other. I mentioned that because there are 6 or 7 younger people, I guess everybody's younger than me, at the Rural Classroom who are more experienced with AI and are beginning to help me. What I've learned myself about AI is that you can't ask it open-ended narrative or opinion-related questions. If you do that, it searches for the preponderance of idiotic responses on X, and AI becomes artificial idiocy. The real uses for AI that I've detected are threefold. The one is asking it very constrained questions, where you also constrain the data set, say to Edgar and CEDAR, where you're using publicly available information that has been audited or reviewed and has been filed with regulators, where the penalty for fraud is very high. AI is absolutely superb at that. The second place it is useful probably is broad-based screens. As an example, I can ask AI to give me a list of net nets, which is to say companies worldwide that have more working capital than they have market capitalization or long-term debt, that are also cash flow positive. Ben Graham used to call those free bonds. You got the cash flow for free because the working capital paid all the expenses. AI can do in 3 minutes or 4 minutes a global screen of net nets, which a human being couldn't do in his or her lifetime. Could not do. The third thing that AI is really becoming good at is what Verify and the other mining software firms are doing, using AI to crunch massive amounts of data to generate concurrent data or concurrent anomalies, to merge astrolimetry, which is to say photo differentiation from space, looking for alteration patterns, with major structures so profound that you actually can't see them on the ground, with historical surface or geochem data, with historic geophysics or underground data. What you do then is you take, say, 1,000 square kilometers of Earth and you sterilize 995 of them. And you apply human prospecting to only 5 kilometers as opposed to 1,000 kilometers. This is revolutionary. This is absolutely positively revolutionary. Because to do this, a single human, first of all, probably wouldn't have the education, but also wouldn't have the time in his or her life to compile all the data and then to superimpose that data, one data set on top of another, to find areas where you had consistently concurrent anomalies.